Hello, hello, and welcome. Another gorgeous sunny day in London. It is the LawyerFair business podcast. My name is Andrew Weaver, and there is a bit of a London theme today, although some of the subjects I hope will be of wider interest to people who are listening to us who are not based in London. But we're chatting today to John Spindler, who is the Chief Executive of Capital Enterprise. He's also the co-founder of the London co-investment fund, and John is going to go through some of the key areas that they look for in terms of investee companies, some of the key things that you should think about in terms of your startup and how you build up the value in the business. He's also going to refer to something called moats, which is not simply something that Conservative MPs have around their country estate. And then we're going to walk into some interesting topics relating to whether London is worth it. Is London worth being the base for your tech startup? It certainly has an expense element to it that perhaps other startup centres don't have, but John is going to go through the reasons why he thinks it's very much worth it. And with this London theme, we couldn't have a musical intro that wasn't from the great London lyricist Ray Davies and the magnificent Waterloo Sunset, voted by Time Out the #1 London song, and who would disagree with them? I hope you enjoy the chat. But John, welcome. It is I was just mentioning to John, it's a glorious sunny day in London. But welcome, John Spindler.
Hello, lovely to be here.
Well, thank you very much for joining us. John, as I've alluded to in the intro, John, CEO of Capital Enterprise and co-founder of the London Co-Investment Fund. Would you be kind enough just to give us a little bit of background about what those two organisations do?
Okay. Well, Capital Enterprise is actually a not-for-profit. It's a membership organisation for kind of organisations in London that support early-stage entrepreneurs. So the members are universities like UCL and Kinks and Imperial and London Business School. They are accelerators such as Entrepreneur First, Camp, Techstars, etc. And they are basically co-working spaces and enterprise agencies. The bulk of our members support early-stage entrepreneurs in the tech space. But we have those that also specialise in creative, led by people like the University of Arts, and a core group led by enterprise agencies and the likes of Princess Trust that deal with those at a disadvantage and to get them to be entrepreneurs for the first time. But the bulk of our 75 members are basically dealing with early stage tech companies that are based in London, and to help them, accommodate them, invest in them, advise them, mentor them, etc. And then about a year and a half ago now, less than a year and a half, basically from December 2014, we set up a new fund, which is called the London Co-Investment Fund, where myself and Maggie Rodriguez Pizza are the general partners of that new fund that has a single LP, co-investor at the moment, which is the Mayor of London and the Greater London Authority. And my job there is obviously as a general partner is to basically run that fund. But principally, my job and the job of our organisation is to find, source, advise, and then prepare interesting investable businesses that we can co-invest with alongside our presently 8 active partners.
John, thank you for that. We're going to come back to the Capital Enterprise Manifesto shortly, which I'm really interested to find out more about. Just a quick heads up on the co-investment fund. John wrote a great article. If you look at John's LinkedIn profile, there's a great article there called The Hateful Eight. Have you seen the film?
Yes, it was obviously kind of slightly taking advantage of that kind of publicity when I wrote it about a month ago.
Quite right too. I've read all those blog advisory articles. I know about headline writing, John. So quite right too. But in there, and anybody who wants to read that, it's a really nice, concise breakdown of what the fund looks for in terms of investee companies, including the lovely phrase that people might not be familiar with is building a moat, which is not necessarily just a Tory MP's extension to their country estate. Just explain a little bit more about that particular aspect of what you're looking for.
Well, it becomes incredibly more important as you go down the chain in terms of your journey as an entrepreneur. It's particularly important when you're starting to look at Series A rounds and beyond. But we have to look at it even at the seed level. A moat is what's defendable about your business proposition. It could be the technology, it could be the network effect you're producing, it could be the brand. It's trying to understand that the value you're creating sticks to your ribs as a company and can't be just replicated and effectively stolen or adopted by another competitor. And that's really important because you think about it, why would a company basically buy your company at a certain stage, or why would anyone buy stock in your company at a later stage? And they do that because they think the value is intrinsic to the business. And that's what we talk about when we mean about a moat. Something that basically is defendable, that others can't just replicate straight off the bat.
Well, what I liked about that particular phrase in that article is I think most of the other things that you talk about in that article, the team, the opportunity, the product market fit, I mean, obviously they need to be stated. But I think people do forget a little bit or maybe underestimate the need to build up those barriers and that defensive position. Would you say that that's one of the areas of weakness that you see?
Yes, I think so, especially because in the early days, when you're just basically starting out, obviously you've just got to kind of see if you've got something that's interesting and you can get to develop a product which effectively can solve a problem in an interesting way that's quite unique to you, that can basically make money for you. But it comes at a later stage when you're thinking about why would anyone want to invest in your business? Mm-hmm. In the end, our co-investors and ourselves are investing in your business because we want to make money when your business is either sold or when the business floats and your shares are able to be traded on all the public markets. Mm-hmm. And that will basically be about why the value that you create sticks to your company and keeps sticking to your company. So traditionally, people have often talked about IP. In our field of tech-enabled, basically business model innovation, the area is less IP and more about the intrinsic way that you deliver value, the network effects that occur when you get to some form of scale, and obviously the brand that you're building and the team you're building, which is quite unique and very hard to replicate. To be honest, when we look at startups,
yeah, no, John, I thought you'd come to the end there. So it's always the issue in with these kind of online chats when you think someone's having a pause. It was a natural pause. I'll allow you to continue.
Okay, well, I often say to startups, why? And I look at myself, and as I've been an angel investor now for quite a while, and also with our fund, is increasingly you've got to kind of think about how will I make money as an angel investor, or how will I make money as a fund? And we have to have at some stage, particularly when we go from where we invest at seed to Series A, what's the kind of end goal here? What's the end vision for this company? And there tends to be 3 main exits. They account for about 60% of all the reasons your business will be bought or you eventually can float. And it's either because your technology and your team is about 18 months ahead of anyone else, and the people will buy your company because they can't wait 18 months to catch up. 2, they're going to buy your company because of market share. You have an interesting market, a definable market share, often in a growing market, often very small, but significant enough that someone can feel that actually it's worth buying at a big multiple because it's going to be so difficult for them to compete and take your customers away from you. So if you have, for instance, the network effect or stickiness or et cetera, they're going to think it's easier for them to buy you now than basically try and compete against you. And the third one, which is what everyone really means when they mean unicorn, is that you are a growth stock, traditionally defined that you basically generate sufficient net cash flow that you can fund potentially exponential growth without further stock dilution. So why I own stock in your company and you keep growing, my stock keeps going up in value. Mm-hmm. And these are the kind of thing that sometimes startups and sometimes even angel investors forget about. They concentrate too much on today or the immediate tomorrow and not enough about kind of what it's going to be in 3 to 5 years' time when that starts to come into play. But definitely at Series A, where you're in that now, you're going to be in that kind of time frame. It's important to kind of start to think about as a startup, what are the moats that you are creating?
John, a brilliant explanation and really fascinating stuff. And I'm going to pick up on something you said within that, which was that you deal with a lot of companies that go from seed to Series A. And there was a stat that I think was from your article, actually. I'm quickly running through my notes. The stat I read recently that in Europe, only 6% of companies that close a seed round subsequently close a Series A round. Was that you, John?
So we got it from actually a VC called White Star Capital,
Right.
who had done some analysis using, I think, CB Insights data on looking at those. Now, it's probably an underestimation because a lot of the kind of rounds are not necessarily always declared.
Sure.
So it's probably slightly more. But what they were saying is the figure is 12% in the States and 6% in Europe. And that because across Europe, wherever you look, there is a shortage, particularly of Series A investors.
Mm-hmm.
So we have quite a good and growing across Europe, particularly in the UK, of people becoming angels and putting the first 20, 25,000 pound in. Mm. We have, because we have a very developed PE industry and a very developed financial service industry and lots of family offices, you can see in Europe you get a lot of later money, rounds led by people that are not necessarily VCs. But in between, we just lack the scale of VCs, particularly who have a track record and confidence investing in tech.
Mm-hmm. Mm-hmm. No, it was an amazing stat, and even if it's slightly higher than that, it's still remarkable numbers. So let me lead us into the core, the bit of this conversation that I'm particularly looking forward to, because being based in London, I love London, but the question is it worth it? And the headline of John's article is: it really worth paying $75,000 more to build a tech startup in London? You were using something called the teleport runway, John, I think, to calculate that. Could you just give us a little bit more information on that, and then the kind of conclusions that you came to within that article?
Well, the teleport basically I came across it about 2 months ago. They produced a very interesting online calculator that looked at the cost of accommodation, the cost of publicly of recruiting staff, and some other kind of factors to try and work out if you have looking to build a small tech team. And the example I put was, say, a tech team of three or four people with the founders, how much it would cost to do that in, say, London as compared to other tech hubs across Europe. And the difference roughly came out around 75,000. And it varied a bit. Some of the tech hubs in Europe are almost as expensive as London, but no one is as expensive as London. And so why not kind of go to Portugal, Lisbon, which is a nice tech centre? Why not go to Berlin? Why not go to Edinburgh? Mm-hmm. And so I looked at the debate of why you come to London and what needs to be done for London to basically really confirm its position as the number one tech hub in Europe. And my fear is that sometimes in London and with the politicians, and we take that for granted and we're too basically complacent about that fact. So if you go on, what did I say? What are the major reasons to come to London? I think the number one reason, this effectively affects a little bit about the EU referendum coming up, is the ability for London to basically attract and service talent. Mm-hmm. And a lot of people will say in London that talent is expensive, but it is available. London is by far the largest labour force in Europe. It's the only mega city. It has a labour force which is enormous compared to any other. You can get tech talent here, but you have to pay for it. The difference if you're in a company, say if you're in, say, Manchester, you will find quite quickly, especially in specialised tech talent, that you basically exhaust the labour pool very quickly, and then you have to poach them from other companies. And that's a kind of a reason why lots of companies, especially from places like Scandinavia, etc., come to London to scale up. Because they can't find, well, it's not just the tech talent, but the marketing talent, the sales talent, etc., and the numbers they need to onboard quickly if they're going to scale.
Well, I was going to say, because the wider ecosystem surely brings great value as well, doesn't it, in terms of
a massive thing. I think actually, London is still the most, probably I think in Europe, the most open ecosystem for a company to actually come into. I think some of that is what we do and what our members do as well to open that up. That's co-working spaces, that's incubators, that's accelerators, but also the ability to basically find in virtually every night in London an opportunity to meet other founders, mentors, investors, which that level of serendipity just doesn't happen in virtually any other city.
No, agreed.
So that's incredibly important. Other factors, access to market is the largest market. We have virtually everything in London. People forget in a federal system like Germany, for instance, media is in Hamburg, industries down in the down in the south and in Westphalia, and Berlin, which people often talk about, is only really the centre for the German kind of economy for politics and basically some social media because it's a younger city than most of Germany. So so we have everything in London. It's almost designed for that. We take it for granted. The fourth thing, and this is a little bit, comes back to the co-investment fund where we have it, is that London's still the best place in Europe to source your Series seed round and Series A round. We don't have enough money. We can't fulfill the role of Silicon Valley or even New York because we just don't have the level of money. But to some extent, in the land of the blind, the one-eyed monster is king. We still have more money than anyone else. We still have more opportunities to invest than anyone else. And that basically means that we get a flood, and we see it as well, for companies coming from outside of the UK or in other parts of the UK down to London to raise a Series seed round and a Series A round.
So John, I'm going to conclude with this. These are all the great reasons to come to London and why London still, in our view, and I share your view, is preeminent in the startup world, certainly in startup Europe. But what are there are 5 points that you're raising in the Capital Enterprise Manifesto that's going into the Mayor of London election. You've already nailed your colours to the mast, I think, and certainly it's one of the 5 points in terms of the Brexit debate. Would you be kind enough just to go through the 5 issues that you've raised that you think can be improved?
Well, one of them is just basically to increase the profile of how dependent the London economy is on startups. Virtually none of the rest of Britain cares about startups. So everything you will hear in the press will be about SMEs and scale up. London's unique in the sense it relies on this influx of new blood, new talent, new innovation to keep our economy going. And it's not shouted enough. And it's because we don't have a CBI or a Federation of Small Business or an Institute of Directors always on the board, always in the ears of politicians and others in the media saying that their members are the key. We don't really have an organisation to support those early stage startups. And they're the ones that are driving the London economy, and I would say, in some extent, driving the UK economy in a better direction, a more sustainable direction. So one of that is just to basically get London and the politicians and everyone to recognise we are dependent on these very basic kind of fantastic and brave and heroic people who start businesses, particularly start businesses where they're innovative, where the chances of success are low, and we should celebrate that. Other factors, I think, is getting basically looking at the costs of living in London and particularly business costs. The campaign in London is going to be all about housing and how we lower costs of housing. I just don't want that to happen at the expense of getting rid of all the affordable space in London. And that's a planning issue. That's a regulatory issue. And we shouldn't basically chop off our nose to spite our face by making it, kind of building more housing for people at the expense of that type of accommodation. I also said basically that, and this is part of my other capital enterprise work outside tech, is that there are still, because the cost of starting a business in London is still slightly unfair and difficult for certain people to be able to start a business. So we should celebrate and support them as well. So that's people opening coffee shops, opening basic service-based businesses in the more deprived areas of London or from more disadvantaged background. And the one obviously that's probably more to my heart is looking at this Series A whole and others and seeing if the mayor can lead a campaign, maybe even seed it with basically a new mega fund, which would basically start to fill the finance gap, but really stops the tech sector, in particular in London, expanding. So people forget that the biggest LPs in America are basically are endowment funds and actually pension funds. And in Europe, virtually no one there is putting 0.5% or 1% of their funds into this tech space because they've just ignored it. And I think the mayor or the other people like City Corporation could effectively help put up a fund of funds that would basically try and address that. We need about £250 million in the sector for us not to be effectively second always to areas like New York and Silicon Valley when it comes to basically building scalable businesses.
Well, listen, John, it's fascinating, really brilliant. I'm going to post both of these articles. They're on John's LinkedIn profile anyway, if you want to see them, but we're going to post both of these articles at the foot of our podcast. Thank you so much for joining us, John.
Thank you.
It's been a marvellous conversation. Good luck with everything, and maybe get you back on later in the year and see how things are developed. See if any of that manifesto has been put into action by the new.
Well, I mean, hope. That's an expectation, to be honest. But
well, that's what we live for. Thanks, John.
Thank you, Andrew. Thank you.
All the best.
Bye.
Cheerio.
fairest now.